Okay, good morning and welcome back, everyone, to our Options Play Daily Play Masterclass here with Rick Bensignor, our Chief Market Strategist. My name is Tony Zhang. I'm the Chief Strategy Officer here at Options Play, and really looking forward to showing you some of the enhancements we've made to the platform to help make sure that you understand how to follow the trading signals that we send out and stick to what we consider best practices with respect to portfolio and risk management. So let's go ahead and jump right into it. We have a lot to cover with you here today. And Rick, thank you so much for joining us this morning.
Of course. Good morning, Tony.
Good morning. And before we get started, what we are going to discuss here today is purely for education and demonstration purposes. It is not a solicitation or recommendation to buy or sell any of the specific securities that we are going to discuss during today's session. And we have a lot to cover here today, but the first thing what we want to do is talk a little bit about the daily play trading signals. Some of you are obviously very well versed in the daily play signals. We have made some changes here this previous week, so I want to make sure that you understand what those changes are and how they will help you with your trading. And for those of you that are brand new, hopefully this gives you a better introduction as to the daily signals that you receive from our research team led by Rick. We'll discuss with you the exact entry details that we email you every single morning so that you're familiar with how to read them and how to use them and adjust them if necessary for your portfolio, specifically around position sizing. Cannot stress enough how important sizing each trade according to your portfolio size is, how important that is. So that's why I want to discuss and show you a new feature that we just released into the Options Play platform, a contract calculator. And it's based on your portfolio size and percentage you're willing to risk, and how it can automatically calculate for you the appropriate number of contracts to trade based on either a trade that you originate your own on your own, or one of the daily play trade ideas that we send out. And then lastly, we'll talk a little bit about some of the changes we're making to the closing trading alerts. And Rick wants to go through some of the trade reviews, especially in this type of choppy and challenging market. We want to discuss some of the things that we're doing with respect to managing risk and deciding when to close out some specific positions. So I'm just going to jump right into it. For those of you that are brand new, the Daily Play is the research piece that Rick and his team puts out every single day at 9 a.m. This is emailed to you, and it's also available to you through the Options Play mobile app. So if you have an iOS or Android device, download the Options Play app, and that will allow you to view the daily play trade that we send out to our members. This is a swing trade idea leveraging some of Rick's institutional timing models. For those of you that have followed some of our webinars on the DeMark and Ichimoku cloud, we're leveraging these primary indicators to find opportunities to swing trade with specific entry and exit points. And just for those of you that have asked some questions regarding the strategy itself, we tend to lean heavily into Rick's work with respect to finding counter trend ideas. And some members have asked us, why we want to use counter trend ideas. And Rick, maybe you could spend just a couple of, maybe a minute just discussing kind of the thesis behind why you choose to use or lean in more towards counter trend ideas rather than trend following ideas, and kind of the math behind some of that.
Sure. Well, I realized many years ago, I've been in this game for over 40 years, and I realized many years ago, Tony, that if you buy deep in an uptrend, when something's just moving higher, like if you take 2021 as an example, the market hardly had not even a 5% pullback over the course of the year. So, you're in an uptrend and it's just continually going. It's very hard to pick a point to play the trend and then also know where your risk level is, such that if you got stopped out, it really is indicative of a change in trend. And this type of thinking goes back to some basic mathematics when you think about standard deviations of price movement, and that the bulk of the people out there who play the markets generally operate in the first standard deviation of all of price movement, the fat part of the bell curve. Very few people consistently sell the highs, very few people consistently buy the lows. And we tend to play in that kind of middle section once we know that a bottom is in place and a market's moving higher. You kind of feel comfortable, okay, let's buy this. And vice versa. If it's sold off and you get a bounce and it starts going down again, you kind of feel comfortable that, all right, we're in a bear market in this particular name. Let's look for bearish opportunities. And the problem always comes back to, how do you manage the risk on that trade? Where do you buy something that's moved up so much and then know where's the proper stop out to get out, that it's no longer going to move up? And it's very difficult to do that because there are so many different support levels in an uptrend. How do you pick the one that really is indicative of, oh, that high up there is actually the high? So when I realized that the bulk of the players on the street have heard you can't pick bottoms and you can't pick tops, and I realized they're playing in the middle of the bell curve, I know historically that almost every time they buy high in an uptrend that keeps moving higher, there is probably as much chance that where their timing of when they happen to have gotten into that particular name could equally give you a down move right from there as an up move. Now, over time, you would think the up move would continue, but from a shorter term trading perspective, which we typically do, so if you know the bulk of the options recommendations we put out are in the 45-day period or less. That's kind of the sweet spot that we've determined is the right way to play options. Sometimes I go a little shorter if I'm playing against an earnings call, but generally we're in that swing area type of time frame. It's very hard to be able to pick consistently the right place to get out, that if you bought deep in an uptrend, you don't get stopped out and then just to see this turn around and go higher again. So when I put this all together in thinking a strategy of how to approach the markets, I realized that the smartest money on the street generally goes against the grain, but they go against the grain at what is not just a haphazard level, but when they have enough information to think that we're actually at a top of a market. And that doesn't come, if you have a stock that, let's say, rallied all the way up to 100, pulls back to 80, goes up to 98 and pulls back under 80, the bulk of people on the street are going to say double top near 100. We've broken the middle of, let's say, the M-shaped pattern. And now you'd say under 80, it's bearish. And that's probably correct, except that you're now 20% off the high before you decide to be a seller. So if you give up that as an example, 20% from the high and 20% from the low before you decide something's bullish, you've only got 60% of all price movement to play with. And you're going to buy high or sell low in that kind of fat part of the bell curve as often as you play it correctly. The only way that you can actually, from a trading perspective, not investing, but from a trading perspective, the only way you can consistently make money over time is to actually be good enough to find the times and places to fade the moves, to sell when the average trend trader is buying into a trend, but they don't realize you're actually potentially at a top, and vice versa on the bottom. Yesterday, I saw a comment on Twitter of somebody saying, you know, commodity names got hit hard yesterday. What changed from Wednesday to Thursday to make all of a sudden commodities that have generally been moving higher sell off? Well, there are often some signals that we'll say more in the know type of people have access to. And some of these signals I share with you on our daily plays and the strategies we do to understand when markets may actually top or bottom when it is completely non-obvious to the average onlooker. And that's why we tend to play counter trend. If you look at the most successful hedge funds on the street, they're not generally playing in the trend. When they put a big position on, they're often going against the trend at the right time. And that's how over time you can make money. And if you use, especially if you use options to, let's say, sell a call spread, when you think it's essentially the top of a move before it's obvious that it's the top. Even on this slide you have, I don't know. Let's see. I'm looking at the prices here. If I can, I'm not even sure which name this is, but it doesn't matter. You see that the 9 that you've shown on the top of the move, that happens to be a price pattern of 9 consecutive price bars. This could be a daily chart. This could be a weekly chart. This could be a monthly chart. I don't even know what we're looking at. But when you have 9 consecutive price bars, that the closing price is greater than the closing price from 4 bars earlier, you often have a near-term inflection point. Sometimes it actually turns into a bigger, longer-term inflection point. If this was a weekly chart, that would have topped after this particular 9-week string and then sold off. And it looks like it took about 10, 12 weeks to find a bottom, but that bottom came on the exact opposite turn. 9 consecutive price bars that the closing price was less than the close from 4 bars earlier. That is part of a model that Tom DeMark developed in the 1970s called sequential. This particular piece of it is called the setup. And we've seen over time that when we get these signals, you often have a turn in the market. When we take a look later, and I'll kind of control the charts here, and we'll look at some of the charts. We'll take a look at what the S&P looks like over the last month and a half, and we're going to see this pattern called this 9 count came one day before the, I guess it was the March high, which is the highest high we've seen since the lows were put in this year. And then we sold off to a 9 down last week, and we kind of stayed fairly steady for a few days. And then earlier this week, we rallied and started what looked like it could be the beginning of another up move. Now, yesterday kind of took that away. And we're down about 10 handles now to start the day, but this is a pattern that we've seen many times in the market, and it helps us often play a near-term transition point in the market at which we're going to put on our option strategies. And it's just one of the many ways we look, but this is a good slide to show the advantage of potentially playing counter trend.
Right. And I think this is really important, and I'm glad you took a few minutes to kind of really dive deep into why we look at these counter trend moves. I just want to do a quick check here for everyone who's here viewing this session here today. Please type 1 into the chat window if that makes sense to you as to why being counter trend allows you to capture a trend early and capture as much of this move as possible, rather than waiting potentially for, let's say, this bar here, where you've now confirmed that this is a bottom, that this is perhaps a level that it traded within some type of consolidation or congestion, if you will, and then it broke out. And you can certainly do that and still make money. You're just making less money, and you are taking a larger risk, because if you enter the trade here, you would have to potentially cut your losses below here. So you're just simply taking on more risk for relatively smaller amounts of reward versus getting in around here and potentially capturing as that much reward with this very tight stop perhaps down here. Your risk to reward just is greatly skewed in your favor when you trade these types of counter trend moves. And we're going to talk a little bit about when these counter trend moves don't work out, some of the trade ideas that we've had that have not worked out, and just how tight the stop can be to help you stop out and get out of the trade fairly quickly with a smaller loss if this trade doesn't work out. And Rick's going to show some of those charts with you. But I'm glad everyone understands here. So let's just walk through some of the changes that we're making in terms of helping you better position this and size this accordingly to your account. So the trade structure that we send out will give you an exact strategy, the expiration date itself, the strike price, and the premium at which it was trading at the time that we generate the signal. Now, the change that we recently made to these ideas is that we are now including the number of contracts that we are selling or buying in this particular trade. Now, what we are doing in this particular case is we are using a hypothetical portfolio where we're taking a $100,000 portfolio and we're willing to risk no more than 2% of the total account value on any single trade. So for example, the Eli Lilly trade here from the other day, We traded 4 contracts of the 292.5, 285 put vertical because this had a max risk of $1,744, just shy of the $2,000 that we would a maximum allocate to this particular trade. I just want to make sure everyone understands that concept. Please type 2 into the chat window if that makes sense to you. And I'm going to show you how you can adjust this based on your portfolio size, because likely you don't exactly have a $100,000 portfolio, and perhaps you're willing to risk a little bit more or a little less as a percentage of your total portfolio. But we also send you specific take profit and stop loss levels based on these trades, as well as based on the underlying stock itself. But that's the change that we're making to the portfolio, to the daily play, is we are trading a hypothetical $100,000 portfolio with a maximum risk of 2% on the particular trade. And sizing your positions is really important to be able to follow our trading research. I can't tell you how important portfolio sizing or sizing is for your success of your trading. As a market strategist over the past 16 years, I have worked with thousands of traders, retail and institutional. And the one thing that stands out between successful traders and everyone else is not their strategy. It's not which indicators they use. It's how they manage risk. The successful traders are the ones that focus more on risk management than how much money they can potentially make. And they are usually very keen on making sure that they never exceed a certain risk tolerance that they have set for themselves. And I can walk you through the math as to why we chose 2%. You can certainly go to 3, 4, and 5% if you wish, but the further you go up, each 1% more that you're risking in your portfolio, the chances of having a significant drawdown in your portfolio rises exponentially. And that's the math that I can show you here on a separate webinar. But it's so important, and that's why we choose the 2% rule. And we never add to a losing position hoping that we'll get yourself back to break even. So we'll show you the rules, how we apply them through this daily play research. But the recent thing that we just launched in the OptionsPlay platform is a new feature, which is a portfolio contract calculator. So I want to show you where this currently is in your platform. So if you go to your platform, either if you go to your profile here by clicking on your name in the upper right-hand corner and clicking on the profile button, or if you click on the risk and investment calculator on your screen, there is now a button that says you can adjust your defaults in your profile. And when you click on this link, it'll take you to your profile risk and income settings. And as you can see, there's now a portfolio risk setting contract calculator. You can type in what percentage of your account you're willing to risk on each individual trade. Here, I've put in 2% for myself, and you can put in the size of your portfolio. This is how you can adjust the daily play research that we send out to you according to your own portfolio size. So if let's say you have a $250,000 portfolio, you can type that in, maybe adjust it to 3% because you have a higher risk tolerance than we do, and you can simply save this as your default setting. And when you go back to the application, and this works whether you are looking at a daily play trade or if you're looking at a trade on your own. When you're looking at a trade idea, you can click on the risk and investment calculator, and it will automatically default to the amount you're willing to risk based on your settings. So 3% of $250,000 portfolio is $7,500. And all you have to do is click on the calculate button, and it will calculate the appropriate number of contracts that you can purchase for the strategy you are viewing at that particular time. Whether you're trading debit spreads or if let's say you're selling credit spreads, all you have to do is go to the risk and investment calculator, click on the calculate button. The $7,500 will be defaulted for you based on your portfolio settings, and you will know exactly how many contracts to enter in this particular trade where your max risk is around the $7,500 level. As you can see in these particular trades, the credit spreads that we're selling here, this one risks 7,300, this risks 7,300 based on your portfolio settings. Does that make sense, everyone? Please type 3 into the chat window if that makes sense to you.
I think it's a great enhancement, Tony, to have that.
And for some of you that are saying that you don't have that, you may be currently logged into the classic legacy app. So when you go to your OptionsPlay platform, you may have the option on the upper right-hand corner that says, if you go to your upper right-hand corner, if you click on your name, if there is a button that says Preview New App, you may be currently logged into the classic version of the OptionsPlay platform. If you see this button here that says Preview New App, this is the, whoops, I can't do this. You see how it says Preview New App right here? Preview New App here on the right-hand corner. If you click on that, that will bring you to the new application, and that is where the new risk and investment calculator is included in the platform. So when you go to the risk and investment calculator, you'll be able to enter your default settings. Like I said, we are trading a hypothetical $100,000 portfolio with a 2% rule. So I'm going to switch this back to 2% and $100,000. And we will use that every time we put out DailyPlay research. We will click on the calculate button, use that number, and that's what we communicate to you. But like I said, you can adjust your own portfolio based on you can adjust the number of contracts based on your portfolio size using this new feature. Okay, so what we now want to talk a little bit about are closing positions. And some of the things that we've recently introduced with Rick over the past few weeks has been opening and closing partial positions. And this is designed so that we are not in a all or none position. Especially in many of these trades, we trade anywhere from a 2 or 3 contracts, sometimes to as many as 20 contracts, depending on the price of the stock. The lower the price of the stock, the more contracts we trade. So we have this flexibility of potentially being in and out of the trade in scaling in and out. So you're going to see sometimes when we communicate to you where we are closing half the position or closing the rest of the position. And this is an important thing to understand. So because we are now communicating to you how many contracts we're opening, we're also going to communicate to you at the moment if we're closing the full 4 contracts. For example, for Eli Lilly, we opened up 4 contracts. We're going to communicate to you whether we're closing 4 contracts or maybe we're closing just 2 contracts and leaving 2 more contracts left to go. And many times what we're able to do is take profits early on a specific trade that's working out and then keeping the other half of the position to try to make that full maximum gain. This will improve our overall returns in these types of strategies in the long run. So those are some of the changes that we recently made. Many of you are already familiar with this, but for those of you that are new, or maybe you're just recently joined here for OptionsPlay, these are some of the ways that you can utilize the research that we're putting out and leverage them for your own portfolio. So with that, what I'll do is I'll shift this over back to Rick because, as we look at some of the trade ideas, some of them simply don't work out. And because we're using these counter trend trades, we figured that out pretty quickly. Disney is an example, and Cisco is another example that comes to mind of where very quickly we recognize the trade structure, the trade itself, or the thesis that we had on the underlying trade is not working out. So we want to talk a little bit about what we want to do in terms of cutting losses fairly quickly to protect ourselves against, major drawdowns in this choppy market. It's been a difficult time to trade. And Rick wants to walk you through some of these examples and the things that we're doing, such as the DailyPlay that we are sending out here today, which is closing some of these positions from the last week that simply are not working out. So Rick, I'll pass this back on to you.
Thanks, Tony. And let me see if I can now take over as host. And I'll share my screen. Okay. Type 4 in the chat, please, if you see my charts. Just want to make sure everybody sees them. Great. Okay. So for instance, here's an example of Match Group, which for those of you who don't know what these guys do, that's online dating. And we had put on a what was it? A 105.95 put spread when we were trading 105. So we almost always set this up that we do the at the money and then something that's out of the money as the hedge side to reduce the cost of just simply having a directional play. And what I do as a trading strategist, and again, I've done this a long time, or the institutional marketplace, and less so for the retail side of the market. That's more in the recent years of my career. If I always think of trades almost always as a multiple step process, meaning I often get in, I might scale into a trade, but I'm almost always scaling out of a trade, because we take away, like Tony was saying, that all or none situation of if I choose one place to get in and one place to get out, then what happens if the market gets 10 cents from where I want to get out, but never gets to my price? Am I really willing to just endlessly stick with this on the hope I get those extra 10 cents when I see it fall $1, $1, $1, and all of a sudden we're giving back everything we made? It's not the way professional traders trade. There's a thought process of close is good enough, and we don't have to be exact. So when we put on an option spread, which is virtually everything we do is a spread. If we buy, just for example, a 100, 105 call spread, if we fairly quickly get to 105, I'm taking half off. It's a great way to virtually ensure that you're not going to lose money on the trade. I've reached the higher strike, which also means that when I first put this trade on, there's a reason I picked the 105, the head strike. It's because, for instance, I saw technical resistance there. So I knew that if we got there, you could easily stall, and maybe even potentially that ends up being the top of the move. You can't tell because things can have multiple support levels, multiple resistance levels. But if I, for instance, put on a 100, 105, there's a reason I picked the 105. And generally it's because I see that as a potential target point that if I was just trading outright, I'd be taking profits, or at least partial profits. So I want to do the same with my option pair trades. So when I'll think of some examples we had, we were long a PayPal 100, 120 call spread, I don't know, month and a half ago. So we bought it when the stock was trading at 100. We have a 120, essentially I have a 120 target. Very quickly after we bought the PayPal at 100, we got to 120. We're near it, enough so that I said, let's take half off. It probably was no more than a week or so out from what was probably a 5-6 week expiration date, and we already got to the upper strike price. I'm always going to take half off when we do that. You know, when we see quick results like that, it's just a smart way to play the market, and yes, it minimizes the potential gain, but the ratio of to your up strike price on a bullish call spread, the likelihood that you're going to make the absolute maximum amount you could at expiration diminishes, especially if that upper strike you purposely picked because there's, in this case, resistance at that level. So I'm always going to take half off in a situation like that. And that's at least my strategy. It might not completely gel with some of the strategies that Tony has taught you over the years, but for me, I like that as take half off, play with the rest. It gives you cushion versus simply hoping that it maximizes out over time. And I'll give you an example in a second of something where I didn't do that because we only had on one contract, so I couldn't do half. It was either all or nothing. And now it's come back to haunt us because we've gone all the way back down to where we first got in. And here, let me pull up the chart on that because that was Moderna. So we got long right around here, the 140 strike price with I think that we put this on in two pieces, a 140, 170, and then very shortly after we put on a 150, 175. And the 140, 170 we got out of and took the bulk of the spread in between. And the 150, 175, because we only had one contract, I didn't get out of. And now you see this has faded all the way back down to virtually where we got back, where we had gotten in. And at this point, I really want to see the bottom of the cloud hold. Otherwise, we're likely testing down to the lows, if not even lower. So within a day or two of subsequent price trading, including today, and let's say next Monday and Tuesday, we're going to know how we're going to play this, and whether or not we're going to take this into its earnings report. But that's why when I put on a pair trade, when I get to my strike price or even close to it, if I have a 9 count, some other new resistance, something that comes up, or my feeling towards the market has changed, I'm going to adjust getting in and out of these options. And you'll see that several of the things we've done recently, and some have worked and some we've gotten a little chopped, is because the market has gotten choppy. And it's hard to understand if we actually want to stay bullish trades or short bearish trades, because now we're kind of very close to, let's look at the S&P itself. Here's where we said that, we had the 13 count, which is the ultimate pattern for the Tom DeMark sequential count. You start with the 9s, and ultimately, if you keep going in the direction of the 9 count, you look for a 13 count, which in this case, let's say when we had let me take the cloud away just to get it out of, when we made this 9 down, notice we had a significant bounce from it into the February high. That was the first time the market had sold off strongly this year. But then we continued, we did a double top, and then we continued down in the same direction that the 9 count went. So the software is going to keep counting, looking for the exhaustion point to that move. And that's when you subsequently get 13 price bars that need not be consecutive days. In fact, I almost always would disregard the signal if it came in consecutive days after the 9 count. You're looking for 13 bars that close is less than the low from 2 bars back. When that happens, you get this terminal count to the sequential model, often saying exhaustion of trend. And that gave us the ability to play a bullish move up in here, but we got bearish, and we actually, if I remember correctly, we put on a bearish QQQ spread 1 day before the high was made. And then it sold off, and we did the 9 down. And that's when we covered lots of the shorts that we had on in our positions, not necessarily because the individual stocks themselves had 9s, but because the overall market did. And a lot of times stocks just move with the market. In fact, it said that 60% of all price movement of any stock is what the market does. 20% is what the sector of the individual stock does, and then 20% specifically to the stock itself. So it's why I always want to have a sense of where are we in the cycles and the timing models within the market itself, because it's going to, if I get bullish signals in the S&P, it's going to make me much more think towards playing bullishly an individual name at any given time. If I'm filled with bear signals for the marketplace, I'm going to generally look to be bearish in the calls that I put out for you. So we always want to know where the S&Ps and the Qs are trading in their structures, so that it gives us a better sense of coming up with individual plays. After last week, I think it was Tuesday of last week or so, we got the 9 count, essentially the opposite move down, and we estimated that usually a 9 count gives you 1 to 4 days, or price bars if it's weeks, 1 to 4 price bars of consolidation of the move and or a turn in the other direction. In this case, we went sideways for several days, frustrated people a little bit, including ourselves, because we weren't sure which way now the market's going. You got the pop, and then yesterday seemingly was a little out of character, because the news that Jay Powell gave us, which is what is attributed to the market selling off, was news that the marketplace was already counting on, which was that we were going to see a 50 BIP raise in rates at the May Fed meeting. So him saying it seemed not to be enough of a catalyst to send the market down, and yet it has. And today, right now, we're down 18 handles again. So we're going to gap lower, and potentially be underneath even the low of this week. And therefore, this short-term 9 may no longer be the right way to look for a bounce. And we may end up going down to 42.52-ish or so, which is where the TDST line is, the lowest low of the 9 count up. It's kind of the process we go through. When we're trading shorter term, you really have to get a sense of what the market's doing. So we're putting this all together as we look at ideas and get in and out of things. Let's take a look at something we put on a couple of days ago, which probably, now this is SYY. This is Cisco, not Cisco Systems, the technology stock, but SYY, this is the food services company. And what I had noticed is that we were on a 13 and a 9 count against the TDST level, so we sold a call spread. And this is a short dated one because they have earnings coming up. So we're either going to probably, and we don't do this too often, but we're either going to lose the max or make the max on this, because it doesn't really pay for me to think of getting out of this because it's gone against us a little bit. I think we sold, what was it, maybe Tony, an 88.5, 92 or something like that. So today in theory should be somewhat lower with a lower open coming to the market. But you get a sense of what made me take something that generally is in a bullish mode and fade the move. And take a look back here in March. You're getting an upside exhaustion signal here. Your standard looking here, if I move this chart over, and let me drag it down so that it's below our photos. Okay, is there any reason your standard technician is, or your portfolio manager who's perhaps more fundamentally inclined, sees a breakout above 84, the old highs from October, gets long, and then immediately faces a massive drawdown? It's completely normal in standard technical analysis terms to think that this is going to move higher. But without this model, you could have easily played that up move, only to be either stopped out as it broke underneath. And notice here too, look, we tested the breakout level this day here, and we closed above it. So you go, okay, I'm fine. Next day, we open a little lower, and then they kill the market. So if you had if you stop yourself out on a closing basis, you paid 87 to get in, and you're selling out at 77 and change. That's a huge drawdown in a very short amount of time after what looked to be a standard breakout. It's part of, and again, how do you determine risk here? Well, you had to stop yourself out if we got back beneath the breakout area. And again, you don't generally do it intraday, you do it on a closing basis. And the closing basis here costs you a ton. It's why we look at the models we do. And these models also give us a sense of where the model's wrong, which is the dotted red line that's usually above or beneath a 13 count. It's essentially the risk level. And it doesn't mean there are rules to getting stopped out too. So the fact that this closed slightly above yesterday wouldn't say it's a bad trade. There are rules, and the rules would not be met in order to have, for instance, gotten out of Cisco. Let's look at, so this one we happen to be staying with. I want to show you Lilly. Now, Lilly is in a down count from the high, but I was willing to play against that this level would hold. Why should that level hold? Well, I think it was this high here against this high here, which stalled, so multiple angle against what were all-time highs at the time for this name. We break out to the upside, and I'm guessing or played that this level, a pullback to the breakout level, and unrelatedly, the cloud model's baseline would hold. It didn't. Therefore, on today's daily play, we're getting out of half of this trade. It only took a day to get out from the day we put this on, because the level I'm leaning on is not holding. And the only reason I'm not getting out of the full trade is that when I add the propulsion model on, it shows yesterday's low was the propulsion level to the downside. So that's why. Now, if we close under there today, then on Monday, we're probably going to get out of the balance simply because the trade idea didn't work. And there is no reason to carry this all the way through expiration or an earnings call or something, hoping it comes back. If you're a trader, you're leaning on levels. If the levels don't hold, there's no reason to be in the trade. And when you have the time to read this morning's daily play that's already come out to you, you will see that I actually explained that in the opening paragraph. I talked about traders trade against levels. If levels don't hold, there is no logical reason to hold on to something, because now you're just hoping that it's going to work. But if the reason you got in is invalidated by the market, there is no reason to hold on. And that's why you think about things that are working, you let run. Things that aren't working, you get out with the small losses. That ensures that over time, you get to play this game this year, next year, and every year to come, as long as you want to play the game. So, Tony, I think that's addressed some. Are there any other names that we should specifically look at?
Maybe just Disney.
Sure.
I think is one that jumps out at me.
Perfect. So again, in this case, I'm going to take the cloud away just because we don't need, it's not going to, we were playing against the triple nines at the same place. 3 times we sold down in 2022, 9 bottom, and we were playing for this to be a 9 bottom, as well as the fact that a 13 count from this 9 back here was showing downside exhaustion. It obviously isn't working. What's the news that kicked it off? Well, Netflix bombing out has taken Disney down and all the streaming names down with it. Then we've got this Florida situation where Governor DeSantis is trying to take a certain beneficial tax structure away from Disneyland. None of that's particularly good news. It's not working. We're getting out. So today, I don't remember, are we exiting the full trade? I think so.
Yeah, that's exactly right.
Sure.
I think the triple bottom breaking is just, you know, it was triple bottom trade. It didn't hold.
It didn't hold. And I'm not going to stick around hoping that the news gets better for Disney or that the marketplace misinterpreted Netflix's numbers and that they've all oversold it. These should all come screaming back to the upside. A triple bottom that breaks is gone and there's no reason to hold the name. So we're getting out, we take our loss. And I've said this before and I will always tell you, take lots of small losses. It ensures long-term survivability. And the best traders in the world will tell you that they get stopped out all the time in ideas. In fact, generally, well more than half the trades they put on, they get stopped out of. It's the ones that work that they really try to ride for as much as they can to offset all the small losses. But think about it, trading, in my view, and I tell my in-the-know trader clients this too, you should probably have no less 80% of all your investable money as investments in the market, not trades. So you should have 2 different accounts, an investment account and a trading account. In a trading account, you can whip around stuff in and out quickly and do what you need to do. But the bulk of your money in life should not be trying to play the game of, oh, is it going to stop here and can we buy against a trend line or a moving average and see something go higher? It's really for, part of it is fun, part of it is to try to beat the market and, you know, do better than other people who play this game. But generally, it's a tough game to consistently make money over time. You really need to have some very good skills to do it. And you really need excellent money management skills. Better than your entry and exit skill is just understanding risk management, as Tony started this off with. It is the single most important ingredient to success in this game, is understanding money management, which is why I love the basic 2% rule. It keeps losses down to a minimum, and you have to manage your portfolio about the losses, not the gains. You manage for losses, you let the gains take care of themselves.
That's exactly right. That's the one thing that you have control over in the market, is how much you are risking in your portfolio. You can't choose, you can't control where the market goes, but you can't control how much risk you take. So I hope that this session here today helps illustrate to you how we exemplify the things that we teach. Everything from the trade strategy that Rick is showing you with the decision process as to when we get in and out of a specific trade, but also more importantly, how we take the number of contracts based on the 2% rule and apply to our portfolio. And hopefully today I showed you how you can use the tools within OptionsPlay to adjust for your own portfolio size. Like I said, we generally recommend that you trade no more than 2% of your total account value on a given trade. So you plug in your total account value, use the risk investment calculator. They'll help you size these trades accordingly for your own portfolio. And I do please leave us some feedback regarding these sessions. Rick and I are back here next Friday. We're going to do another session to basically cover again some of the daily play ideas, go through some of the ideas. There were a lot of comments saying that we should do these more often. So Rick and I are coming back next Friday. We're going to do another session here just on the daily play, reviewing the open trades, walking you through trades that we've closed and kind of the thought process behind why we close certain trades, either at a profit or a loss. And let us know what you think about these sessions, because it helps shape what sessions Rick and I host going forward. So with that, the markets just opened up here a minute ago, so we will let you go. I know many of you have trades to place, so we will let you go. And we do have, we will make one adjustment here to the Nike trade. There was an issue in the published price. It was $6.87, not 60 cents. We will make that correction and send that out to you. With that, thank you so much. I hope you guys have a great trading day, and I'll see you guys here. You'll see Rick on Monday, and you'll see me later in the week.
8:45 a.m.
Thank you so much, guys. Have a great trading day.